The music just stopped. Just a few weeks ago, in early October, the crypto market felt like pure euphoria. Bitcoin smashed through its old all time high, touching an astronomical $126,000 per coin. Twitter was on fire, retail investors were piling in, and it felt like the moon was just a pit stop on the way to Mars. Today, as of mid November 2025, Bitcoin is struggling to hold the line at $93,000. Ethereum is back below $3,200. And the crypto fear and greed index has cratered to a score of 10, a level of extreme fear we haven't seen in years. What on earth happened? This wasn't a random Sunday dump. This wasn't some black swan event from out of nowhere. This was a direct consequence of a massive structural deleveraging event that has completely changed the game. On October 10th, the market experienced the single largest liquidation event in its entire history. Over a gut-wrenching 24-hour period, a mind-boggling $19 billion in leveraged positions were forcibly wiped off the books. 1.6 million traders were liquidated. This wasn't a correction. This was a reset, a full systemic purge, and the entity holding the reset button, the ultimate source of this market whiplash, is the one institution that crypto was supposed to make irrelevant: the Federal Reserve. The Fed's unexpectedly persistent stance against inflation has sent a shockwave through every risk asset on the planet, and crypto was ground zero for the impact. In this video, I'm going to break down exactly what the Fed is doing, why it triggered the biggest liquidation cascade in history, and most importantly, I'm going to explain why this brutal, gut-wrenching, short-term pain is creating an entirely new and potentially far more powerful long-term forecast for both Bitcoin and Ethereum. We need to talk about what just happened, why it happened, and what is coming next. To truly understand the scale of what just happened, we have to go back to the beginning of October. The mood was electric. Bitcoin had just broken its previous all-time high, climbing past $125,000 and even touching $126,000 in a powerful display of strength. Analysts were publishing price targets of $140,000 by the end of the month. Open interest on derivatives exchanges was at record highs. It felt like nothing could stop the momentum. But beneath this euphoric surface, a dangerous amount of risk was building up. The rally was increasingly fueled not just by spot buying, but by extreme leverage. Traders were using perpetual futures contracts on exchanges like Binance and Bybit, taking on 10x, 20x, even 50x leverage, betting that the price would only go up. This is like building a skyscraper on a foundation of gasoline-soaked toothpicks. As long as the market goes up, everyone feels like a genius, but the moment it turns, the entire structure can implode. And on October 10th, the market turned hard. The trigger was a macroeconomic shock. News of renewed geopolitical and trade tensions, specifically a threat of major tariffs on Chinese goods, ripped through the financial world. This wasn't a crypto-specific event, it was a global risk-off moment. Investors worldwide fled from risk and ran towards safety. And crypto, the riskiest of risk assets, was hit like a sledgehammer. Bitcoin plunged over 14% in a matter of hours, crashing from over $120,000 to below $102,000. But the price drop itself wasn't the main event. The main event was the liquidation cascade it triggered. As the price fell, those highly leveraged long positions that were betting on the price going up were suddenly underwater. When a trader's position falls below a certain threshold, the exchange's risk engine automatically force sells their collateral to cover the loan. This is a liquidation. Now imagine this happening to millions of traders at once. The first wave of liquidations created a massive wall of sell pressure, which pushed the price down even further. This, in turn, triggered the next wave of liquidations from traders who had their stop losses set a little lower. It's a terrifying, self-reinforcing death spiral, and the numbers are just staggering. Analytics firm CoinGlass confirmed that over a single 24-hour period, $19.16 billion in leverage positions were wiped out. To put that into perspective, the liquidation event during the FTX collapse in 2022 was around $3.5 billion. The COVID crash of March 2020 saw about $1.2 billion in liquidations. What we witnessed on October 10th was magnitudes larger than those historic crashes. It was, without a doubt, the largest deleveraging event the crypto market has ever seen. The carnage wasn't limited to Bitcoin. Ethereum fell hard, and altcoins were absolutely devastated, with many dropping 15% or more in a day. And the market hasn't recovered. The bounce was weak, the confidence was gone. By mid-November, the selling pressure continued, pushing Bitcoin down below the psychological $100,000 level, and eventually testing support at $93,000. Ethereum is now struggling to hold $3,200. As I mentioned, sentiment has collapsed into a state of extreme fear, with the index hitting a multi-year low of 10. This isn't just a dip, this is a fundamental change in market structure. The speculative froth has been violently scrubbed away, the market has been reset, and the core reason why the market can't just bounce back is because the underlying macroeconomic environment dictated by the Federal Reserve has fundamentally changed. So, why did this happen now? And why isn't the market showing signs of a quick V-shaped recovery like it has in the past? The answer lies with the Federal Reserve and its war on inflation. For the better part of a year, the market's rally was built on an assumption that the Fed was done hiking interest rates and that rate cuts were just around the corner. Lower interest rates and an increase in the money supply, or liquidity, are like rocket fuel for risk assets like crypto. When money is cheap to borrow, investors are more willing to take risks to find higher returns. Crypto, being the ultimate high-risk, high-return asset, benefits massively from this environment. The entire run to $126,000 was predicated on the idea that the Fed would soon turn the money printers back on. But in late 2025, the narrative began to crack. Inflation, which was supposed to be cooling down, remained stubbornly persistent. Economic data, which was supposed to be weakening, came in stronger than expected. This gave the Federal Reserve a clear reason to maintain its higher for longer stance. When the Fed is hawkish, it means they are focused on fighting inflation, even at the expense of economic growth. Their primary tools are maintaining high interest rates and quantitative tightening, QT, where the Fed actively shrinks its balance sheet, effectively pulling money out of the financial system. Think of high rates as the Fed pressing the brakes on the economy, and QT as them siphoning gas out of the tank. For months, the market was betting that the Fed would pivot, but recent statements sent a different message: the fight against inflation is not over. This realization is what pulled the rug out from under the market. The easy money party was over. The Fed was, to use a classic analogy, taking away the punch bowl just as the party was getting good. This has a direct and immediate impact on crypto. When you can get a relatively safe return on a government bond, the incentive to gamble on a volatile asset like Bitcoin diminishes. As a result, capital flows out of the riskiest assets first. Crypto, being at the far end of the risk spectrum, becomes the market's ATM. When institutional investors need to de-risk their portfolios, crypto is often the first thing they sell. This brings us to the ETF story, which has become far more nuanced. While the launch of spot Bitcoin ETFs was a monumental success, the institutional demand it unlocked is not a one-way street. In 1 week, in November 2025, Bitcoin ETFs saw net outflows of over $1.1 billion. This is a critical point. The institutions that everyone thought would create a permanent buy wall are also susceptible to macroeconomic fears. They are not immune to the Fed's policies. When the Fed tightens, institutional players become cautious and they reduce their exposure to volatile assets just like everyone else. Compounding all of this is the persistent cloud of regulatory uncertainty. Throughout 2025, the SEC has continued to delay its decisions on a host of new crypto ETFs. We've seen deadlines for spot Solana, XRP, and Litecoin ETFs pushed back into October 2025. While delays are not rejections, they prevent new waves of capital from entering the market and keep a lid on sentiment. The SEC is moving cautiously, trying to establish a comprehensive framework for these products, which is a good thing for the long-term health of the market, but in the short term, it just adds to the list of reasons for investors to stay on the sidelines. So, you have a perfect storm. The Fed is draining liquidity from the system, making risk assets less attractive. Institutional players, spooked by the macro environment, are now net sellers through the very ETFs that were supposed to guarantee perpetual inflows, and the regulatory pathway for new products remains frustratingly slow. This is the why behind the crash and the subsequent weakness. The entire foundation upon which the rally to $126,000 was built, the expectation of imminent rate cuts, has been shattered. And now, for a quick moment. If you're finding this breakdown valuable and want to stay ahead of the Fed's next moves and understand what they mean for your crypto portfolio, do me a huge favor and hit that subscribe button. It's completely free, and your support is what allows me to spend the time digging into this research and bringing it to you. It helps the channel more than you know. Okay, so we've dissected the pain. We understand the what and the why. Now let's talk about the most important part, the opportunity this has created and what comes next. All right, everything we've discussed so far sounds pretty bleak. A record-breaking liquidation, a hawkish Fed, institutional outflows, and regulatory delays. It's easy to look at this picture and feel the extreme fear that the sentiment index is showing. But here is the contrarian view. Here's why this brutal, painful market reset might just be the single best thing to happen to this crypto cycle. First, let's talk about why this was a healthy and frankly necessary reset. The run up to $126,000 was becoming unstable. It was fueled by an unsustainable amount of greed and leverage. When a market is propped up by borrowed money, it is inherently fragile. The $19 billion liquidation event, as painful as it was for those involved, was a market cleansing event. It wiped out the speculative excess. It flushed out the over-leveraged gamblers, and it transferred assets from weak short-term hands to stronger long-term holders. Think of it like a controlled burn in a forest. It looks destructive, but it's essential for long-term health. By getting rid of the excessive leverage now, the market has built a much stronger, more stable foundation of actual spot holders. The next leg up, when it comes, will be built on a bedrock of genuine conviction, not on a mountain of precarious debt. This reset means the subsequent rally will have the structural integrity to push to much higher highs. Now, let's talk about Bitcoin's new forecast. The sentiment is in the gutter. The fear and greed index is at 10. The news headlines are all about the crash. This is precisely the environment where smart money begins to accumulate. Remember the old adage, be fearful when others are greedy and greedy when others are fearful. Right now, the market is terrified. Despite the recent turmoil, long-term price targets from serious research firms remain incredibly bullish. For instance, JP Morgan, even after this massive correction, reiterated a price target that implies a theoretical price of around $170,000 in 2026. Other forecasts for 2026 show a median price target around $201,000. More conservative outlooks suggest a potential trading range between $99,000 and $140,000 could be in the cards. So, what will drive this recovery? The fundamental drivers haven't gone anywhere. The Bitcoin halving, which cut the new supply of Bitcoin in half, is still exerting its powerful deflationary pressure on the asset. The political environment is also seen by many as becoming more crypto friendly, which could lead to a more favorable regulatory landscape. Institutional adoption is not a straight lineup, it's a multi year process. The institutions that sold are not gone forever. They are simply waiting on the sidelines for a clearer signal from the Fed. Once the macroeconomic environment shifts, which it will eventually, that massive wall of institutional money will be waiting to re-enter the market, and this time they will be entering a market that is far less leveraged and structurally sounder than it was just a few months ago. Finally, let's talk about Ethereum. While Bitcoin is the macro asset, Ethereum is the decentralized internet's base layer, and its fundamental story might be even more explosive. Ethereum is currently trading around $3,200, but the range of speculative forecasts from analysts is staggering. Some see a path to between $7,000 and $8,000, while more bullish predictions suggest Ethereum could reach as high as $10,000 by the end of 2025 or into 2026 if conditions turn favorable. What is behind this explosive potential? It comes down to fundamental network growth and massive technical upgrades. The most important of these is the Pectra upgrade, which went live in May 2025. This was one of the most feature-packed upgrades in Ethereum's history. Pectra introduced several game-changing improvements. For one, it significantly increased the staking flexibility for validators, allowing them to stake up to 2,048 ETH per validator instead of just 32. This simplifies operations for large staking providers and institutions. More importantly for users, Pectra brought massive advancements for scalability. It effectively doubled the data capacity for layer 2 rollups by increasing the number of blobs per block. In simple terms, this gives solutions like Arbitrum and Optimism more highway lanes to post their data, which directly translates to lower fees and faster speeds for end users. It also introduced EIP 7702, a form of account abstraction that allows regular user wallets to temporarily act like smart contracts. This unlocks incredible new possibilities, like letting users pay transaction fees in tokens other than ETH and creating more secure, user-friendly wallets. The Pectra upgrade is making Ethereum faster, cheaper, and easier to use. This isn't just speculation, it's code that is already live and running on the main network. This fundamental improvement in the network's utility is what will drive real adoption. While Bitcoin's value is primarily as a store of value, Ethereum's value comes from its utility as the world's dominant smart contract platform. And with the Pectra upgrade, that ecosystem just received a massive turbocharge. So, let's bring it all together. The Federal Reserve, with its persistent fight against inflation, hit the reset button on a crypto market that was dangerously overleveraged. This triggered the largest liquidation event in history, a $19 billion wipeout that sent Bitcoin tumbling from its all time high of $126,000 and plunged market sentiment into a state of extreme fear. That was the problem, the short term pain. The implication is that the market can no longer count on the tailwind of easy money from the Fed capital has flowed out of risk assets, institutional ETF demand has seen significant outflows, and regulatory uncertainty continues to linger. This is the difficult, choppy environment we are in now, but the forecast, the long term outlook, has been reshaped for the better. This brutal reset has purged the market of its speculative excess, creating a much stronger foundation for future growth. The long term bull case for Bitcoin remains firmly intact, with sober analysis still pointing to a return to the $170,000 to $200,000 range. And the bull case for Ethereum is arguably even more powerful, with the monumental Pectra upgrade fundamentally enhancing the network's speed and utility, setting the stage for a potential surge towards the $8,000 to $10,000 range. The market has been reset, the leverage has been cleansed, the tourists have been scared away. The question now is, with a stronger foundation and the most powerful fundamental drivers still firmly in play, is this brutal washout the single greatest buying opportunity of this entire cycle? Let me know what you think in the comments below. What's your Bitcoin and Ethereum strategy heading into 2026? As always, thank you for watching.